It is hard to imagine a period of greater economic uncertainty than the one that gripped the world in 2008. This was not a slow decline or a measured recession, but a sudden, terrifying collapse of confidence rooted deep within the American housing market. The reverberations were felt instantly across continents, demonstrating just how interconnected the modern global financial system had become. The seeds of this disaster were sown in the years leading up to the crisis, specifically through the proliferation of what we call subprime mortgages. These were loans granted to borrowers who possessed poor credit histories and therefore carried a high risk of default. Lending institutions, driven by competitive pressure and the promise of quick profit, loosened their standards drastically. They convinced themselves that rising housing prices would always provide a safety net, allowing them to recoup their investment even if the borrower failed to pay. The traditional rules of responsible lending were fundamentally abandoned in this pursuit of unsustainable growth. It seemed as though everyone was certain that the housing boom would continue indefinitely. The key to understanding the scale of this problem lies in understanding how these risky loans were packaged and sold. Lenders did not keep these dangerous mortgages on their own books. Instead, they bundled thousands of them together, transforming them into complex financial products known as mortgage-backed securities. These bundles were then given impressive ratings by credit agencies, often misleadingly suggesting they were safe investments. These supposedly reliable securities were purchased enthusiastically by banks, pension funds, and investment firms around the world. The financial world convinced itself that diversification meant safety, believing that even if some homeowners defaulted, the sheer volume of other loans in the package would absorb the losses. This complex securitization process effectively masked the toxic levels of risk accumulating throughout the system. When interest rates began to rise, the adjustable rate mortgages that many subprime borrowers held reset to higher payment levels they could not afford. Defaults surged dramatically, transforming what had been a localized housing problem into an existential threat for major financial institutions. The intricate web of securities, which were built upon these failing mortgages, suddenly became worthless. Institutions holding these assets faced catastrophic losses that wiped out huge portions of their capital instantly. Confidence evaporated overnight, and banks suddenly refused to lend to one another, fearful that any counterparty they dealt with might be on the verge of insolvency. This freezing of the interbank lending market is the defining characteristic of a full-blown financial panic. Amidst this chaos, the name that came to symbolize the breakdown of the entire system was Lehman Brothers. Lehman, a storied investment bank with a history stretching back over 150 years, was deeply invested in the market for these now toxic assets. As the market value of their holdings plummeted, their counterparties demanded immediate payments, leaving the firm without sufficient cash flow to survive. Despite frantic negotiations and desperate attempts to find a buyer, a bailout did not materialize. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection in the largest filing of its kind in American history. The failure of such a prominent institution sent shockwaves through the global economy, demonstrating that no institution was truly too big to fail. The decision not to rescue Lehman was intensely debated, but its immediate effect was to accelerate the crisis dramatically. The ensuing fear triggered massive withdrawals from money markets and threatened to seize up the global credit machine entirely. The collapse of this venerable firm marked the precise moment when the financial crisis transitioned into a deep, global economic recession. It proved that the contagion was real and immediate. The consequences were far-reaching and deeply painful across the globe. Ordinary citizens in countries far removed from the American housing market felt the impact almost immediately. Trade finance dried up, stock markets plummeted worldwide, and unemployment rates soared as businesses were unable to secure necessary operating capital. Governments in Europe, Asia, and the Americas were forced to inject massive amounts of taxpayer funds into their banking sectors to prevent total systemic collapse. The ensuing recession, often referred to as the Great Recession, was the deepest and longest economic downturn since the 1930s. Millions of people lost their jobs, their homes, and their life savings in an event caused by a complex cocktail of deregulation, greed, and catastrophic financial innovation. The crisis exposed fundamental weaknesses in regulatory oversight and highlighted the dangers of unchecked leverage. The resulting economic environment forced a painful period of deleveraging and austerity for many nations struggling to recover stability. It forever changed the public perception of the reliability and trustworthiness of major financial institutions. Understanding the mechanics of the 2008 crisis, from the ill-conceived subprime lending to the shocking failure of Lehman Brothers, is essential for recognizing the risks that persist in the financial world today. The memory serves as a potent reminder of the high cost of speculation when critical checks are removed. If you are interested in deconstructing more pivotal moments in financial history and understanding how market dynamics affect our daily lives, you should explore more of our detailed analysis. Be sure to check out the rest of the videos available on Financial Quake for deeper insights into economic complexities.